Hi everyone, I hope everyone is doing good. My name is Kavya Ravichandran, one of the ACCA tutors. Today in this session, we are going to discuss about the pre-December mock 2025. We're going to debrief the whole mock. So we will go step by step for section A, section B, section C of all of the parts of your entire mock examination. And I will be explaining the answers. I'll be explaining how to write the answer, how many minutes you have to take for each section. Everything will be covered in this whole mock. Yeah, so without wasting our time, let's get into the session. So this is the CBE practice platform where it will be available for everyone who's registered under ACCA. So once you get into CBE practice platform, if you want to assign your mock, all you have to do is select browse available examination, and then you have to go with exam category financial reporting. And once you see that, you just have to scroll it down. You'll be able to see FR pre mock December 25 mock exam, and you just have to assign this. Once you assign, come back, go to view assignments. You'll be able to see pre mock December 2025. You just have to click on start. It acts exactly as the way how your examination screen looks like. There won't be any single change. So if you're ready to start the examination, go start the exam. So here there won't be any kind of timers which will be running like your real life examination. It's your job to go ahead and keep the timer on so that we know we are writing the mock exam in just 3 hour period time. So you just have to go through all of the instructions. It's just like your real life examination. So instruction 1 to 4, you just have to scroll it up. Without scrolling it up and down, you'll not be able to move to the next screen. Like, I directly go select next screen. It says you have not yet viewed the entire screen. So you should first go through the entire screen, like it is all the instructions. Please take a minute and read. If you're writing for the first time, if you've already written many other papers, maybe it is not for you. Yeah, so once you select all the instructions, once you read, you'll have to move to the exam summary, which this exam will be of section A within 15 questions of 2 marks each, and for section B, which again 3 case scenarios which each have 5 into 2 marks, which is again 30 marks it will cover. And then section C with a constructed response question of 40 marks in total. Okay, so let's start with section A first. So you just have to scroll. Yeah, then we'll move to section A. Now we'll keep the timer on. Yeah, without timer it will not be having an issue. Please keep the timer on, and I will be starting next. See, so if you see, the very first question that we have is about cash generating unit. I all know is about impairment loss. Okay, all the time if I want to know what is the question, I have a habit of understanding what is the requirement before getting into the question. It says what is the carrying amount of the building following recognition of the impairment loss. That means this is something that they're asking after the impairment loss, not before the impairment loss. So that means I have to allocate impairment loss to all the cash generating unit, and then whatever the carrying amount that we get for the building especially is what this question is for. So I will always highlight what are they asking. We need to find out. It is about carrying amount of the building after following the recognition of impairment loss. This is what I know. Now I have calculator given in the examination, and I also have a scratch pad. I'm going to use scratch pad so that whatever I write, whatever I explain, it is there and you guys will be able to find it out what am I talking. So if you see, this question has clearly said the cash generating unit has the following carrying amounts in blue company's financial statements at 30th June 20x7 before allocation of impairment loss. I have all the details before allocating impairment loss. I have goodwill. You don't have to write the full forms, guys, in the exam. Do not waste your time. Goodwill, I have $550,000, and I have plant with $950,000, and I also have building with 1.3 million, and I have intangibles with $400,000, and I have net current assets with $430,000. These are all the total value of my asset. So now you don't have to calculate the recoverable amount because they have clearly said the CGU is found to be impaired by 1.13 million. Please highlight it. This is something that you need to know. So it has been impaired by 1.13 million. That means what is your impairment loss in this question? Impairment loss that we have to allocate is $1,130,000. That is nothing but 1.13 million. So how do we allocate? If you all go back to your impairment loss, we have certain rules to follow. The very first thing is, I will see if there is any specification given for this question. So is there any particular assets recoverable amount is given, so that I know how much impairment is happening or whether the impairment is happening or not. If you see the next sentence, on this date the plant had a fair value less cost of disposal of 1 million. That means the plant has a carrying amount of how much? 950. But however, the recoverable amount of plant would be considered as how much? It is just 1 million. So that means, can I say no impairment happening on plant at all? So there won't be any kind of impairment happening on what? Happening on plant. Now, so there is a specification which makes myself understanding plant will not get impaired at all. So please make sure that you have to strike through the plant in your question while you're calculating, so that you know you're not going to allocate it. Do not waste your time. So first thing, no specification given, there is no impairment on plant. Second thing, I have to allocate the whole impairment on goodwill first. You have a goodwill, the entire goodwill has to be allocated. So out of $1,130,000 of impairment loss, I will reduce goodwill of 550. So the goodwill will not be available for what? Will not be available for the impairment loss at all. So when I open the calculator to find out what is the difference, you have to select standard or scientific. So you can take the standard so that it becomes easy for you. Out of $1,130,000, I deduct how much? I deduct 550, and that gives me a value of how much? Remaining 580 to be allocated. This is what I know. What is the next step in impairment? That as far as I know, there won't be any kind of impairment on net current assets, because most of the net current assets will always be at its recoverable amount. No impairment loss at all. So due to which I will not allocate any impairment loss to the net current asset. Now the remaining 580 to be allocated between two assets. What are the two assets? One is building, another one is intangible asset. So the intangible asset, so it has a ratio of, if you see, building has a value of 1.3 million, right? And your intangible asset has a value of 1.4 million. So for the total worth of how much? Total worth of 1.7, I have to allocate 580. Now do not waste your time. All we need to know is building. If I know what is the impairment loss on building, it is quite easy for me. So how do we allocate? 580 is the impairment loss that I have to allocate, multiply to the proportion of building out of the total value of 1.7 million. So that makes my impairment loss for the building how much? 443,529 approximately. Now if impairment loss to the building would be how much? Impairment loss to the building would be, so $580,000 multiplied with 1.3 divided by 1.7. This is what we have done. It is based on proportionate method. I have 443.529 impairment loss. After impairment loss, what will be the carrying amount, guys? I had an asset worth of building of 1.3 million. In that, approximately 443.529 has been impaired. The remaining carrying amount would be 856,471. The answer for this question should be 856,471. You shouldn't be wasting your time, right? So right after that, we can move to the very next question. Looks like we have a theoretical question here. So let me just delete off my scratch pad. I don't need this anymore. Then we'll move to the theoretical question. IASB's conceptual framework for financial reporting defines recognition as the process of incorporating within the financial statement an item which meets with the definition of an element and satisfies certain criteria. Of course, like if you have to recognize anything into your business, it should always meet with the element, a definition of the element. If I have to bring it as an asset definition. So regarding this, they're trying to say which of the following elements should not be recognized in the financial statements of an entity in the manner described. That means They're asking whether we can recognize or not. Very simple. Which of the following elements not? Only one answer. Okay. So as a liability, provision for operating losses expected in the next 12 months. See, I will close my eyes and say this is my right answer, because I will never create a provision if I have an operating losses expected in next 12 months, 3 months, any months, like tomorrow it's happening. I, as long as it is not a loss making contract, if it is my regular operating losses that is going to happen in the future, I will not treat it as a provision nor liability. So the answer has to be by default option A. But however, for our self satisfaction, we can always read the remaining options. See, option B, as income goods delivered to customers for which payment is still pending and the customer is responsible for any damage of to the goods. Guys, I believe as far as the transfer of control of the good is done, then I can consider that as my income. My performance obligation is satisfied, I can treat it as my revenue. That's what they say. It is completely right. And as an asset, the present value of the cost of decommissioning a plant at the end of its useful life. If we all remember initial measurement of IAS 16 property, plant and equipment, we have something called decommissioning cost. So we will discount it to the present value and we will consider that as my asset. That is also right. Next, as equity, rights issue is a default equity, guys. There shouldn't be a double question about it, second question about it. So the answer has to be option A, and I can straight move to the next question. Now, again a theoretical question, but see, looking at the question, you feel it's theory. It is not most of the times. Okay, look at the next one. Brake company owns land that was purchased on 1st January 20x2 for 2 million. The company initially held the land for capital appreciation. So we all know, if the land is held for capital appreciation, the land is held for capital appreciation, we call it as what? We should call that as IAS 40 investment property, as far as I know. Okay, then look at the requirement. Now do not waste your time, read the heading and go for requirement. How should brake company account for the change in use of the land on 1st January x4? Now sometimes we waste our time in reading the whole part, like from where it is getting changed to what. See, if initially I would have recognized this land as IAS 40, if there is a change, the change will definitely be to IAS 16 PP. You really don't have to go through and read the question, but for self satisfaction we can always go through. Look at the second one. On 1st July x4, brake company occupied the land and began construction as its new head office. At that date, fair value of the land is 2.5 million. See, I initially purchased the land for 2 million. After almost 2.5 years, I have gone ahead and changed the purpose of the use to property, plant and equipment. On this date, my fair value is 2.5 million. There is an increase of $500,000. If you all remember the transfer between IAS 40 to IAS 16, I will treat this as what? I will treat this as fair value gain to statement of P&L account under investing category. Do not consider this as revaluation surplus, because it is not a transfer from property, plant and equipment to investment property. It is rather the reverse, like it is from IAS 40 to 16. Hence, any increase or decrease should go to statement of P&L account first. However, read it. Brake company uses the cost model to measure its owner occupied buildings, that is property, plant and equipment. Fair value model to investment property in accordance with IAS 40. Of course, the answer has to be any transfer from the investment property to PPE should be recognized as 0.5 million or $500,000 as fair value gain in the investing category of the statement of P&L account. Close your eyes and say the option is, answer is option number 1, because if you see any other option, the second option is talking about like the land is transferring from investment property to PPE and it's carrying amount. No, it is a 2.5 million. Option C, I am looking at the last option. It says other comprehensive income. There shouldn't be a word other comprehensive income at all, so that shouldn't be an answer. And we continue to measure the land at 2 million without any transfer between asset categories. No, we have to make changes. So technically the answer has to be option A. Right. Let's move to the next one. Okay. I don't know why it is already pre-selected. Yeah. So we will move to the next question, and the next question talks about what? Oh, what is the total expenses recognized in the statement of P&L in the year ended 31st December 20x4? Okay. So all right, so the requirement, always keep it, it's about leases if I can see. So on 1st Jan X4, Ponder Company entered into a lease agreement to lease an item of machinery for 4 years with the rentals of $250,000 payable annually. Okay, starting from 31st December X4. As far as I know, this lease is what? This lease is about payments in arrears. So the question is about what is the total expense. If you have ever seen my classes, guys, total expenses, I always say in leases only one thing, that is depreciation of right to use asset plus finance cost on lease liability. These are all the two things together. We have to treat it as what? We have to treat it as total expenses. If you see, it's going to be a 4-year rentals, but however, if you read the further thing, the asset has a useful life of 5 years. Now, as lease term is 4 years, but the asset has useful life of 5 years. Do I have to take 4 or 5 for the calculation of depreciation? I'll take 5, because the next line says at the end of the lease term, legal ownership will pass to Ponder Company. That means if there is a transfer of ownership, doesn't matter, I will charge a depreciation on the total useful life of the asset. So what is the value of the right of use asset? They have clearly said the present value of the lease payments at the inception of the lease was $750,000. So this will be the value of right of use asset as well as the value of lease liability. So hence my depreciation will be of $750,000 divided by 5 years, and that should be, do not waste your time taking out $750,000. All you can take is 750 divided by 5, and you should get an answer of $150,000 of depreciation. And finance cost, now we always do not read the question properly and will quickly go to the conclusion. Sometimes, you know what, they will not ask for the same year ending, they might ask for the next year ending. Luckily in this question it's the same year ending. Now my finance cost will be of the opening balance of the lease liability $750,000, that into 12.2 percentage, that will be of approximately, as far as I know, 91 change, but let me just calculate. It will be 750 multiplied with 12.2 percentage, and that will be 91.5, that is 91,500. So depreciation will be of 150 and finance cost will be of 91.5. If I add both of them, my answer should be 241.5. The answer should be $241,500. Okay, so let's move to the next question. Okay, again, like we have the financial instruments question. Look at this. What amount should be recognized in other comprehensive income related to these shares? Guys, OCI shares. That means it is fair value through OCI. If it is fair value through OCI, if you go back, the initial measurement should happen at fair value plus transaction cost. If it is through P&L, only fair value. So now since it is fair value plus transaction cost, now read the point. Regan Company purchased 10,000 shares on 1st September X4, making the election to measure them at fair value through other comprehensive income in accordance with IFRS 9 financial instruments. On this date, the share costed $7.65 per share. That means I have purchased 10,000 shares. Purchased 10,000 shares multiplied with 7.65 each should give me a value of 76,500. But however, we have also included a transaction cost associated with the purchase of how much? 1,500. Since it is going to be treated as what? It is going to be treated as fair value through OCI. I should add what? I should add $1,500 to the initial measurement. My opening balance is 78,000 now. Now, what is my closing balance? To find out what is the total gain, my closing balance is R at 31st December X4. The shares had a fair value of $8.5 each. So you don't have to do the maths, like 10,000 into 8.5, that means $85,000 is the closing balance. The opening balance is 78. The closing balance is 85,000. So that should give a gain of $7,000 for us. 78 minus 85. That should be the answer. So here they have asked you to enter the whole dollar. You have to just enter 7,000. Do not put full stop. Do not put comma. Do not put dollar symbol. Don't do anything. Just give the numbers. Right? That's the fifth question that we have solved. Now move to the theoretical question. Okay. Um, which two of the following criticisms apply to current cost accounting during a period of inflation? Okay, so it's about criticism that they're talking about. Okay, so that means it should be a wrong thing, something disadvantage of a current cost accounting. I'll go from the least. It says it is less useful for decision making than historical cost accounting. See, I think when you do current cost accounting, it is actually more relevant for decision making than the historical cost accounting because it is up to date in nature. Correct. So this shouldn't be the answer because it is not a criticism. Correct. It is not a limitation, actually speaking. The telling wrong. Now go to option C. It reflects price of assets prevailing at the time of consumption of the asset. See, again, this is not a criticism but rather it's an advantage. It reflects the same price of the asset while it is in the usage of the market. That is actually the advantage. Like we know exactly what is the value of the asset that we are using. So answer has to be option in A and B. In the exam, do not waste your time sitting and justifying, okay, this could be wrong, this could be right. It requires frequent revaluation of assets which can be subjective and complex. Yes. Guys, if some multiple people are gonna use the current cost accounting, it is going to be subjective. Everybody has a different perspective, every organization has a different usage, and it is going to be complex in nature. It is very much true. Second, everybody will use different evaluation method. I use market approach, you use income approach, somebody else use cost approach. So that could be the criticism. As far as I know, that should be option A and B, right? So let's move to the next question. Okay, this is really nice question. Let's take a pause and read about it. So let's read the question. The question says on 1st April X7, Chimpy company delivered a machine to a customer. The machine was priced at $260,000. So we have this machine which is worth of $260,000. The customer had a right to return the machine for a full refund at any time up to and including 30th June X7. See, you might have gone ahead and sold it on 1st April X7, but till the time it becomes 30th June X7 and the asset is not returned, that's when we have to consider that as revenue. Until then, we can't consider that as my revenue, neither my revenue nor my receivables. Okay, so now if I have to consider this part, what do I have to simultaneously create? Because there is a point saying that if in case if the customer comes back to you, you have to give that amount back. What is that amount called? As a refund. So hence it's my job to consider that as my refund liability. I don't treat this as what? I don't treat this as my revenue anymore. Like, I mean, I don't treat this as my amount that is receivable to me. Rather, I create what? I create a liability to this. This is a new customer, and at 1st April X7, Chimpy company was unsure whether they likely to return the machine on or before 30th June X7. I don't know what exactly they do. Even probability analysis or not there. So I would have to go ahead and consider this as what? I would have to go ahead and consider this as I will go create a refund liability by debiting what? By debiting the receivables. I will not go ahead and consider this as my revenue at all. Okay, that should be the answer. Let's move to the next one. Very nice question this is. Look at this, guys. On 1st 30th November X3, Vermizell company purchased land in another country with a cost of 45 million euros. The land was classified as property, plant and equipment measured using the cost model. Very nice. It's about a foreign currency transaction question. At Vermizell company's year end 31st December X3, it had paid 36 million euros of the amount but still owed 9 million to the seller. Now everyone, you have to understand, it's a property, plant and equipment cost model. We are not even revaluing it. We don't touch the property, plant and equipment. I will keep the asset on the day of purchase. On the day of purchase, that was which date? 30th November X3. On this date, whatever my exchange rate was there, that is the value of the land that you can expect to have even at the year ending, because क्योंकि cost model I'm following, plus there is no depreciation because it's a land. I will keep as it is for 45 million euros on that date, whatever my exchange rate was. So on that date my exchange rate was $1 के लिए 3 euros. So for 45 million divided by 3 euros, the asset value will be held at 15 million only. The carrying amount of land will be 15 million. If you see in that scenario, option B and option D is ruled out. You don't have to consider those questions. So what is the next thing that you'll keep? Now, the next thing that you'll keep it is, will the payables be 4.5 million or 3 million? Now, all of you guys tell me, what is the balance of payables? The balance of payables here 9 million. Correct, because I still owe to seller how much? But still owed 9 million to the seller. So at this point of time, whatever the value that you have, this is treated as monetary liability. Q monetary liability, because any amount which is there to be settled, we call that as monetary element. Payables monetary item hota hai, receivables will be monetary asset, all the liabilities, loan notes, debentures, everything will be monetary liability, because you can only measure through money, and it is always a contract to right to receive money or right to pay money, like obligation to pay money, sorry. So payables is my obligation to make payments, so it will be my monetary liability. So it's my job to retranslate on year ending 31st December X3. So on that date, I still owe 9 million euros to the seller, but on the year ending 31st December X3, the exchange rate is 2 euros per dollar. Please do not take average rate. We never take average rate in the exchange rate. It is always spot exchange rate. On this date, the value of the payables would be 9 million euros divided by $2 per euro, 2 million per 2 euros sorry per dollar. That will give us 4.5 million. So the answer for this question has to be option A, because I will retranslate my payables to 9 million. The 1.5 million will be treated as my fair value, exchange loss going to statement of P&L account. So the answer has to be option A. Okay, let's move to the next question. So this is really nice question. It's about IFRS 5 non-current asset held for sale. Let's all go through this. On 1st November X5, Jamia's company held a factory with a carrying amount of $10 million using cost model. Very nice. The factory had a remaining useful life of 10 years at this date. So yearly depreciation lagbhag is 1 million. Jamia's company intended to sell the factory as soon as a major customer order was completed. This was expected to take at least a year, minimum 1 year. Okay. First of all, if I have to keep it at IFRS 5, there are certain conditions. First, the asset should be ready to sell as it is in its condition, and this should take place at least within a year. Here, minimum kam se kam it is taking 1 year. Okay, so you don't have to read further to say it is IFRS 5 first of all, because it is not IFRS 5. However, let's read. Jamia's company started marketing the property for sale on 1st August X6 at a price of 14 million. Okay, which was the fair value property's fair value at that date, and cost to sell is 0.5 million. At the year ended, the customer was still incomplete. The customer order was still incomplete, but it was expected that this would be completed at the end of November 20x6. The fair value of the factory on that date was 14.4 million and cost to sell remained as 0.5 million. See, as far as I know, the moment they say this, it doesn't come under IFRS 5 at all, because it says clearly Jamia's company intend to sell the factory as soon as a major customer order was completed. That means it is not ready to sell its present condition. It has a job to finish and then to be sold. So I don't treat it as IFRS 5. I rather consider this as property, plant and equipment. I don't measure any other values. My 1st November X5 value is having how much? Is having a value of 10 million with 10 years useful life. By the time I moved to 31st October X6, 1 year would have been done. 1 million depreciation, that is my carrying amount should be 9 million. That is 10 minus 1, 9 million. Right? Now, let's move to the next bit. This is really nice. It's about sale and lease back. Look at the requirement. Their question is, what gain on disposal should Expanse company recognize in P&L in relation to the sale and leaseback of the building in the year ended 31st May 20x9, and you have to give the answer in one decimal. And if you see the answer box, it is million. So the question is about what is the gain that we have to recognize in statement of P&L on the profit on sale of non-current asset. So whenever sale and leaseback happens, I sell the ownership but retain the control. Correct. I sell the ownership, I retain the control. So hence, I have to find out the profit related to the ownership, not to the control. Correct. So in this scenario, if I have to take on 1st July X8, Expanse company owned a building with a carrying amount of 21.6 million. On this date, we sold it for 36 million. So what is my profit for both ownership and control? दोनों मिलके I have what value? I have 36 million. I have 36 million. That minus 21.6 million. So what was my total profit? 36 million. 36 million minus 21.6 million. So my profit for both is 14,400. Okay. So profit is 14,400. But let's understand what is the fair value of sales proceeds. The sales proceeds of 36 million is given for both ownership and control. दोनों के लिए. But however, if you read the next information, what does it clearly says? It clearly says the remaining useful life of the building on 1st June X8 was 25 years. Good. The sale and leaseback agreement required payments of 2 million payable annually in arrears. Okay. On the same date, the present value of the future lease payments was 30 million. That means I myself have purchased control for 30 million. That means, can I say the fair value of control itself is how much? Control itself is 30 million. Now, I have a profit of 14,400 for both ownership and control. Correct. And my fair value of control is 30 million. That means, can I say my fair value of ownership is 6 million? Because I sold both control and ownership to a person for 36 million. I purchased the control for 30 million back. That means the ownership has a value of 6 million. So that is nothing but 30 is to 6 ratio. 30 has a ratio for control, 6 has a ratio for ownership. Can I do the same thing for profit? In the profit, it's 30 is to 6 ratio. 30 for control, 6 for ownership. I can only recognize profit for ownership because I sold only ownership, not the control. So if I do this, all I have to do is take 14,400 into 6 by 36. Should give me the value of the profit. So I'll take 14,400. 14,400 multiplied by 6 divided with 36. So 2.4 million should be my actual profit related, or else you can do the cross multiplication. So 2.41 decimal should be the answer. Great. So let's move to the next question. Very nice question it is. Okay. See, Farfield company has sold washing machines with a 1-year standard warranty as part of its contract for sale for 6 years. Okay. So in the year ended 31st December X5, it sold 125,000 machines, and in the year ended, it sold around 135,000 machines. On an average, 8% of machines sold in a year need to be repaired under warranty. So at each reporting date, the repairs department estimates the average cost per repair in the coming year. Okay. At 31st December X5, the future repair cost was expected to be $50, but the next year it has been increased to $58. What statement reflects the current accounting treatment in Farfield companies? Blah, blah, blah. Okay, I get it. Like, by the time you come here, you feel a little exhausted because there's too much of knowledge. See, always process each one by one. Ek statement we have to divide and understand. I know these people have sold goods with a 1-year warranty. Okay. So I always keep in the year ended 31st December X5, I've sold 125,000 machines. I predict always 8% of machines sold will come back for warranty. So that means on 31st December 20X5, I should have predicted I sold 125,000 machines. For the next year on this 8%, for every machine it will come to me, I will have to incur $50 per machine should be my provision value that I have to go ahead and create. Correct warranty provision. Yeah, if I have to do the same thing in the calculators, it's going to be 125,000 multiplied with 8%. Oh, is it 125? Okay. 125,000 machines into 0.08, that into $50 per share. So what should be the provision that I have to go ahead and create? I have to create a provision worth of $500,000. This is which year? This is for the year ended 31st December X5. Okay. Next year के लिए, अगली साल के लिए, I should have a provision of at least how much? 31st December 20x6 के लिए I have to have a provision of 135,000 machines into once again 8% into now $58 because of what? The provision balance should have this much. So if I have to do the calculation, 135,000 machines into 8%, that into $58 should have a value of how much? Should have a value of 626,400. Now most of us does this mistake. Look at the options. Fairfield company has a constructive obligation and should make a provision for 626,400 in the statement of financial position. The question is, which statement reflects the correct accounting treatment in Fairfield company's financial statements for the year ended 31st December X6? Guys, please understand, not X5. I would have already created a provision in the last year for $500,000. That's my closing balance. This year I should have a closing balance of 626,400. That means the increase in the provision is only 126,400 and I record only 126,400. The answer has to be option D. Fairfield company has a legal obligation. You have signed, there is an invoice which is given and you have sold, there is a receipt which is issued. You're legally bound to give the warranty. It is a legal obligation, first of all, not a constructive obligation to recognize an expense in relation to the provision for warranty of 126,400, because your closing balance is 626,400 and opening balance is 500. The increase is nothing but 500 minus 626.4, so that is nothing but 126.4, that is 126,400. So the answer has to be option D. Do not go select option A because we always get confused. Okay, great. Let's move to the next question. Really nice question. Okay, on 1st September X4, Moore company sold an item of heavy plant to a customer for $460,000. The plant was delivered on the same day. The customer paid a deposit of $50,000 on delivery, and Moore company provided the customer with 2 years interest free credit on the balance of the cost. The appropriate discounting rate is 6%. Guys, always record the transaction at present value, please. At present value unless otherwise told. Now out of $460,000, 50 is already in present value because we got that money, correct? But remaining $410,000 will be paid after 2 years. I have to now discount for 2 years using what? Using 6% cost of capital or rate of interest. How do we calculate $410,000 multiplied with 1 divided by 1 plus R is 6% raised to the power n. N is 2 years. Take the calculator. First calculate 1 plus 6% raised to the power is nothing but 1. Let me write 1.06. That is 1 plus 6% into 1.06. That gives 1.1236. I'm going to keep this for the calculation. So what do I have to do? 1 divided by 1.1236 6 multiplied with $410,000 should give me the value of 360. So if I discount it, the present value would be 364,899. Let's keep 899 or 898 plus the present value of 50,000. So my answer for this question, because it's already there in the present value, if you add, it should give you the value of how much? 4898.5. This should be my answer. When I go to the drop down, I should have my answer. That is 414. Oh, is it my bad? 364. Let me do the recalculation. 364,899 plus 50,000. We should get the value of 414,899. So your answer has to be 414,899. Maybe I would have messed it. So that should be the answer for this question, because one is at half of the amount is at present value, half of the amount I will get it after 2 years, but I have to record it in today's term. So I will go ahead and consider. So this should be the revenue. What if they would have told you about receivables, then you had to unwind the discount for the receivables since you have discounted to the present value. Yep. Okay. Let's move to the next question. Yep. This is really nice question. Read it apart. See, on 1st July X8, Field Farm Company received a $90,000 grant from local government to support its expansion. The grant was used to acquire a tractor costing $240,000 on 1st August 20X8. The tractor has a useful life of 10 years. Very nice. So it's a government grant, but they have not specified whether the grant is calculated according to the deferred income concept or reduction in the value of the asset concept. So which statement correctly reflects the accounting treatment permitted by IAS 20 government grants and disclosure of government assistance? You can do both deferred income concept as well as you can reduce the value of the asset. However, if you see this, the grant income of $90,000 is recognized in P&L for the year ended 30. I don't think so. It's an answer, because guys, even if you do deferred income basis, out of 90,000, only 9,000 should be recorded every single year. Rest all will be there in the deferred income. Right, but look at option B. Grant income of 4,500 is recognized in the P&L in the year ended 31st December X8. Somewhere I feel the right answer, because the grant I received is on 1st July X8. My year ending looks like, what is my year ending here? The year ending here is 31st December X8. That means somewhere I feel like 6 months if we prorate it. Yeah, so if $90,000 I divided for 10 years, it should be $9,000 for every year. This into 6 by 12, I should actually get a value of 4,500 to be recognized in the current accounting period. Some are the right answer. But however, let's see option C and D. The grant is presented as a liability with a carrying amount of 86,250. It should be a deferred income, which is a liability. But what should be the balance, guys? The balance should be $90,000. We will go ahead and consider 4,500. The remaining balance liability should be how much? The remaining balance liability should be, oh good lord, 4,500. Should have a value of 85,500. But here they are trying to say it is 86,250, which shouldn't be the right answer. Next, so it is not a right answer. Option A is also not the right answer for me. Look at option D. The tractor is presented as property, plant and equipment with a carrying amount of 144,500. If I would have reduced the value of the asset, then I have a purchase cost of $240,000. In this, if I would have reduced $90,000, then the asset value should have been 1,50,000. In that, if I would have calculated depreciation of 10 years, 15,000 should have been my depreciation, but I would have calculated 6 months ke liye 7,500. My asset value would be 150,000. If I reduce depreciation, it should actually give me a value of 142,500, not 144,500. I think this is also wrong. The answer has to be option B. That should be the right answer. I'll go recognize the grant income for 6 months because the year ending is 6 months. Chalo. Let's move to the next question. This is a nice question again. In the year ended 31st October X8, Missile Company incurred the following expenditure: $330,000 to buy the rights to a soft drink formula on 1st Jan X8. The rights were determined to have a indefinite useful life, but fine. Do you see it's an identifiable asset? Yes, because you bought it through rights. Yeah, there's a right for you to get. So $330,000 can we consider that as my intangible asset? Yes, because if you read the requirement, what amount should Missile Company report as intangible assets at 31st October X8 in respect of this expenditure is what is being given. That means how much is the intangible assets, right? So if you see on $330,000, I will still consider because it is identifiable. It is acquired through separate legal, because you bought the rights. It has happened through the contractual rights, so it is identifiable in nature. But no amortization because of what? Because of indefinite useful life. Okay. Second, $12,000 to register a legal right to the formula on the day it was acquired. The right has no termination date. Again, $12,000 is identifiable, coming into the picture of no amortization as usual. Why? Because it does not have any termination date, one thing. Second thing is it is acquired through a legal right, so it is by default identifiable and we treat it as intangible asset. But look at the third option, $45,000 to build up the list of customers and their preferences. It is purely an internally generated asset, internally generated intangibles. You are not supposed to recognize this irrespective it has useful life, not useful life, because it is not identifiable. The amount that is incurred, you can't tell somebody this is my list of customers and this is the preferences, let me sell it without selling the business. Doesn't work out. Last thing comes on $150,000 acquire technology on 1st July X8 and it has a useful life of 10 years. I will consider $150,000, guys. I don't have a problem. But the problem here is my purchase. मैंने purchase की on 1st July X8. But my year ending is 31st October X8. And it has a useful life. I have to calculate July, August, September, October. 4 months ka amortization. Correct? So if I have to calculate 4 months of amortization, how much it's going to be? $150,000 divided by 10 years into 4 by 12. So if I do that, take my calculator and check it out. $150,000 divided by 10 into 4 divided by 12, $5,000. So if I reduce $5,000 from here, what is my carrying amount? My carrying amount will be $150,000 minus $5,000. It will be $145,000. What is the total value as at 30th October X8? Because see, if you take the rights to buy the rights or to register it, it does not have any definite useful life, so no amortization. You can take $330,000 plus you can also take this $12,000. But when it comes to the technology, you have to take the carrying amount of $145,000 instead of what? Instead of $150,000. So my answer should be $487,000. Right? Great. So let's move to the next question. Oh yeah, this is a really nice question that I had to discuss. Look at this. On 31st December X8, its year end, Sidley Company decided to change the assumption used to measure the cost of its inventory from average cost to first in first out method. The measurement of inventory using both the methods were as follows. If you take the consideration, they've been using average method. Now they want to shift it to FIFO method, first in first out method. So because of this, there could be a changes happening in cost of sales. Okay. So what are they asking? Which statement is correct in relation to the financial statements for the year ended 31st December X8? See, all I need to know is what is the actual effect on this part. Look at this. The question is for 31st December X8. Okay. What do you think would have happened? This is a change in accounting policy, not a estimate. Accounting policy, where I have to go ahead and apply retrospective effect. What kind of retrospective effect I'll have to do? Change the cost of sales every single year and restate it. That's what I have to do. Now, I need to know closing balance of previous year is opening balance of current year. That at least I should know. Okay, now read it. At 31st December X6, it was supposed to be 52,500, but it is actually 55,100. I have to increase it to 55,100. Correct. So closing inventory of 20X6 and opening inventory of 20X7 is increased by how much? It is increased by the difference, that is 55,100 minus 52,500. Now I have to keep it at any more what value? Oh good lord. 55,100 minus 52,500. The difference is 55,100 minus 52,500. 2,600. So there is an increase in my opening inventory of 20X7, increase by 2,600. First thing. Second, closing inventory of 20X7 and opening inventory of 20X8 is increased or decreased? I think okay. 50, if you go to X7, so the value should have been 5400, but it is actually 52,100. 52,100 minus 5400. There is an increase of how much? There is an increase of 1,700. That's all you should understand till now. See what's happening. Now read the options. If you take the year ending, if you take the year 31st December X7, your cost of sales should increase by 2,600, because if you take the opening inventory of 20X7, it is increased by 2,600. If opening inventory increases, cost of sales will also increase. But if closing inventory increases, cost of sale will reduce. So if you take 20X7, my opening inventory increased by 2,600, cost of sales increased by 2,600, but closing inventory also increased by 1,700, but my cost of sales will reduce by 1,700. Increased by 2,600, reduced by 1,700. That means my cost of sales overall should increase by $900. That should be the answer. Cost of sales in the comparative statement of P&L for the year ended 31st December X7 is restated and increases by $900. Ma'am, why the remaining 3 is not an option? Prior period adjustments of 2,500 is disclosed in the statement of changes in equity. Guys, it doesn't, cost of sales increase by 900, the profit will reduce by 900, equity has to get changed by 900 in the year ending 31st December X7. X8 though, we would have actually made the changes and this would have been actually taken place. I don't think so it's a problem. Similarly, inventory in the comparative statement of financial position is measured at 5,400. Guys, it will be measured at $56,500 क्योंकि we are asked about for the year ending 31st December X8. Whenever there's a change in accounting policy, अगर retrospective effect होगा in the statement of financial position, we have to give comparative figures of previous year in the current accounting information. That's the reason option is A. And clearly if you look at the option D, this is a change in accounting estimate, no prior period adjustment is required. A change in accounting policy होता है. So it requires what? It requires, it requires what? It requires the changes happening in retrospective effect. That is your section A for you guys. In the examination, you should be taking hardly 40 minutes to solve this section A questions. So I've taken some time to explain you guys, type everything, but you should be able to do it in your own calculators as soon as possible and have your stationery so that you can write on the stationery and then you can solve it. You'll be given a sheet paper, right? Sure. So let's move to section B now. So section B, this section is of the exam contains 3 OT questions. Each OT questions contains a scenario which relates to 5 OT questions. Each question has 2 marks. Once again, it is of 30 marks. Let's start. Always you have to consider what? You have to consider what is being asked. Don't read. It's a theory question which is not even relevant to this. Always read the question first. The measurement of inventory at the lower of cost or NRV reflects which of the qualitative characteristics? As far as I know, it's gonna be a faithful representation. क्योंकि timeliness तो नहीं है, because you change cost or NRV, जो भी you change it, end of the day you will provide the information on a particular date only. I don't think so it's a big deal. And understandability, verifiability, these are all enhancing qualitative characteristics. If you take faithful representation, that is very basic. And keeping the inventory at either cost or NRV, whichever is lower, is actually true and fair view. So my inventory cannot be sold more than this value. That's the reason we reduce to cost or NRV. So hence it has to be what? It has to be faithful representation because it gives true and fair view. Faithful representation is being neutral, being free from errors, and providing true and fair view. That is called faithful representation, right? Now let's move to the next question. Now we have to calculate what is the carrying amount of the equity component of the convertible loan notes at 31st December X8. Now start reading. If you see, this is about convertible loan notes. Catch the keyword, convertible loan notes. Where is the loan notes available? Convertible loan notes. ये तो last है. Look at this. Dane company issued 8% 30 million convertible loan notes on 31st December X8 at par. Interest is paid annually in arrears on 31st December every year. An equivalent loan without the conversion option would carry an interest rate of 10%. The loan notes are redeemable and convertible after a period of 5 years at the option of loan note holders. Good. Now what do we have to do? We have to understand how debt component of the question is calculated. How debt component of the question or convertible loan notes are calculated? The debt component of the questions are calculated present value of all the future cash flows at market rate of interest. The debt component out of convertible loan notes are nothing but PV of, that is present value of all the future cash flows associated with this loan notes. इसमें I can expect to have 2 cash flows. One, every year interest payments. Every year interest payments for which, how many years? For 5 good years. That will be of how much, guys? That will be of 30 million is your par value. That multiplied with 8%. So you will have to pay oh come on, come soon. Okay, thank you. So you'll have to pay 8% multiplied with 30 million multiplied with 8%. That will be 2.54 million. So you'll have to pay 2.4 million every single year for 5 years time. So now to calculate the present value, what you need, can I take annuity factor for 5 years? I will add all the discounting factors, that becomes annuity factors to me. So what do? I'll take point. Now do not take 8% ka discounting factor. You should always discount it through the market rate of interest. I'll take 10% of discounting factor. It is 0.91. It is 0.91 plus 0.83 and 0.75. 0.68 and 0.62. So So that should give me the total annuity factor of how much? 3.79. So if I have to calculate the present value of all of this interest payments, what I can do, I can take 2.4 million as my regular cash flow, multiply with 3.79. That should give me a value of how much, guys? That should give me a value of 2.4 million. 9096. The present value of future interest cash flow is 96. But we also have one more value that we call it as what? That we call it as principal repayment. Now this principal repayment is not going to happen every single year. It is going to happen at the end of 5th year. So 5th year, I will have to make a payment of 30 million. That multiplied with what is the discounting factor for 5th year alone? It is 0.62. So what do I have to do? It is 0.62 here. So what do I'll do? I'll take 30 million multiplied with 0.62 should give me a value of approximately 18.6 million, 18,600,000. Now, agar if I add both of that, my interest cash flows have a present value of 9096 and my principal repayment has a present value of 18,600,000. That makes my debt component how much? My debt component 27,696,000. Now calculate. Out of 30 million, 27,696 is debt component. Remaining will be equity component. So all you have to do is minus 30 million. If you are conceptual strong, then you should get this answer within a minute. I have explained it so that you guys know. You should know, understand properly. So the answer for this question has to be option C, $2,304,000. So let's move to the next one. It says, which of the following statements is incorrect according to the IFRS 18 presentation and disclosure in financial statements? Okay, entities are permitted prepare financial statements for a period shorter than a year. Maybe it could be correct. Yeah. And the next one is assets and liabilities should be aggregated based on characteristics that are shared, disaggregated based on characteristics that are not shared. If you would have studied IFRS 18, that's what is given in your ACCA study hub itself. So that should be right. And assets and liabilities and income and expenses should not be offset unless other IFRS accounting standards requires or allows offsetting. That is true. You can't offset, you can't say asset and liabilities, income and expenses, okay, you can't just go reduce that and directly say it's my revenue. No, that's not possible. You have to do the heading wise until unless the standard tells you to do. So option C is also right. What is incorrect? Presenting trade receivables net of an allowance for credit losses is example of offsetting. No, it is not an example of offsetting. This is a receivable. This is a provision created for the receivable and I reduce that. That's the accounting treatment. It is not called as offsetting at all. It is not an example of offsetting. So this is incorrect. Yeah. Let's move to the next question. The next question now, it is clearly based on what? It is based on revenue. Yeah. So now you have to read the part of revenue. It's about the next scenario altogether. We are done with the 5 questions. It's altogether next scenario. See, here if I go back to the previous questions, hardly I have questions which is related to the information given. Oh, I think we missed this question, guys. I'm sorry about it. Let's redo this question. We missed 2 questions. I'm sorry about it. My bad. The question here is, what is the correct carrying amount of inventory in Danae's company's financial statement at 31st December X8 to 2 decimal places? Just like how convertible loan we have completed, we have inventory and trade receivables. In inventory, in the draft financial statements, look at this. Danae's closing inventory is 8.6 million. We have a closing inventory of how much? Closing inventory of 8.6 million. Okay. In this, product A, which actual cost is 0.36 million, that is $360,000, was incorrectly included in the balance at 0.63 million. So what do I have to do, guys? I have to eliminate the excess that I have calculated. How much I should have recorded? I should have recorded 0.36 million, but I went and recorded 0.63 million. The difference, it's my job to go ahead and reduce it. So how much is the difference? 0.63, 0.63, or you can take it as 630. 630 minus 360, it's a transposition error. So 270, it's my job to go ahead and reduce, that is 0.27 million. So 270 I will reduce first thing. Next, what is happening? Product B was included in its cost of 0.4 million. However, it could only be sold for 50% of the normal selling price due to a technological fault in one of its parts. Okay. But Dane's company charges a markup of 30% on product B. It's very simple. I have to reduce the inventory once again. So I have a cost worth of 400. It is normally sold at 30% markup. You add 30% to it. It is sold for $520,000. That is 0.52 million. But in this, because of some excess condition, I can only sell it for half of it, which will be 260. My NRV is 260, my cost is 400, but I recorded at 400. It's my job to go ahead and reduce the remaining part 140. So I will go reduce the remaining 140. If I do the whole calculation, I should have a value of my inventory 8.6 million minus 270 minus 140. So that should give me a value of $8,190,000. If I have to, they've clearly said it should be in decimals, 8.19 million. I'm just removing. If you divide it with 1000, you should get the same answer. 8.19 million should be the answer for this question. Great. Let's move to the next bit. So the next one talks, which of the following reflects the correct accounting treatment of the factoring of Dane Company's trade receivables in the year ended 31st December X8. What is factoring, guys? Factoring is like I'm selling my receivables. Sometimes I bear the risk, sometimes the opposite person bear the risk. If I bear the risk, I treat it as loan. If opposite person bears the risk, I treat it as sales. Because the risk is transferred. A receivable is an asset, you're selling it for complete amount and you don't have any risk in the future, then it is my sales. I can consider that as my receivable is gone. But if I am going to bear the risk in the future, then it is not a risk. I rather pledged my receivables to take money. It's treated as my loan. Okay. Now read the trade receivables. On 1st November X8, Dane factored, sold 2 million of trade receivables to capital company, some company, with received an immediate payment of just 1.8 million. Under the factoring agreement, any receivables not collected after 4 months will be sold back to Dane. No accounting entries have been made in relation to factoring agreement. Guys, first of all, I will not de-recognize my receivable. ये तो sale ही नहीं है, because this is not at all a sale. I will get it back if those people are not gonna pay. They will sell back to me. I'm the one who should collect it. So hence I don't treat it as what? I don't treat it as my sale. So I treat it as loan. If you can see, I can see only thing is a receipt of 1.8 million should be treated as loan. Now, why this doesn't represent without a recourse factoring agreement? So, if in case, if the asset is not going to be sold back to you, it is called as without recourse. I mean, you can't get it back. Matlab, if risk is not transferring it to you back, that we call it as without recourse. Here the risk is going to get transferred back, that we call it as with recourse. Okay. So this with recourse, so hence the option C is not the right one. The receivables I will not de-recognize because it's not a sale only, I can't de-recognize. And an administrative expenses shouldn't be recognized because I'm getting money. If I'm getting money of 1.8 million, I think I debit cash at the bank and I have to credit an entry which will be treated as loan. The receipt of 1.8 million should be treated as a loan. Right? I think we finished this question. And then we finish this question. Then we finish this question also. Yes. Now we have to go to the next set of scenario based questions. Okay. It's clearly about the revenue. What adjustments needs to be made to revenue in respect of the commission based sales by Harry Company? Read the whole revenue part. included in Harry's drafted revenue is 20 million relating to the machines sold to customers on behalf of number of manufacturers. Okay, fine. $18 million is included in Harry Company's draft cost of sales, representing the amount payable to the manufacturers. The difference of 2 million is the commission that manufacturers have agreed that Harry Company can retain as commission. If you collect 20 million and out of the 2 million is your commission, I will credit 2 million as my revenue. Remaining 18 million should be treated as my payables, because I'll get money. I debit my cash at bank of 20 million, out of which 2 million will be treated as revenue and remaining 18 million should be considered as payables. I have to give back to the manufacturers, because ultimately they are the one who should get this value money. So now, because they are the one who's bearing the risk, I'm just an agent, they are the principal. So here, but what I have done, I have gone ahead and considered to 18 million I have considered in cost of sales. Okay, representing the amount payable to the manufacturers. The difference of 2 million is the commission that the manufacturers have agreed that Harry Company can retain as commission. Nothing, guys. We just have to reduce my revenue by how much? Reduce my revenue by 18 million and cost of sales by 18 million. What else is there? I don't think so any big deal is there. So we don't have to go through anything else. See, reduce revenue by 20 million and reduce cost of sales by 18 million. See, that's not the case, guys. What I have done here, I have already included 20 million as my revenue. Is my 18 million I have to de-recognize. But in cost of sales, I have recognized only 18 million. So that 18 million I have to eliminate. So the answer has to be straightly option D. Increasing revenue by 2 million not required. And you can't say I will not make any changes to cost of sales. Increase 2 million but increase cost of sales. No, you have to eliminate cost of sales. The answer is pretty simple. Reduce revenue by 18 million and reduce cost of sales by 18 million. Okay. Now let's move to what is the weighted average number of ordinary shares to be used in the calculation of Harry Company's basic earnings per share for the year ended 30th September X7. So what we can do, we can go ahead and consider this value, that is ordinary shares. Please keep it, please make sure that we calculate this easy, because it's very easy but sometimes we get confused on that. So what we have to do, we have to go ahead and consider at 1st October X6 Harry had 36 million equity shares in issue. So the opening balance is treated as what? So the opening balance will be treated as what? The opening balance that I have is 36 million equity shares. Okay, and on first, this is happening on which date? 1st October 20x6. So after that there is a subscribed rights issue which is happening on 1st Jan x7. That means October, November, December I had 36 million shares. So I will time apportion with 3/12 for that. But when I move to 1st January x7, I made a rights issue. So this rights issue caused an additional shares, one for every 4 shares. I had 36 million. I would have given 1 for 4. That means I would have given approximately 9 million shares. Yeah. So that will be 36 million. 1 divided by 4. I would have given at least 9 million shares. So that means I had 36 plus 9 million. Together now I will have 45 million shares. 36 plus 9. Together it becomes how much? It becomes 45 million shares. This was there in the business for remaining number of months, 9/12. But now, since there is a rights issue, it's my job to calculate bonus fraction for rights issue. How do we calculate bonus fraction for rights issue? It is market value of the share divided by theoretical X rights price. Read the next one. So we have made the rights for $2.8 each, but the market price of the equity shares of Harry immediately before the issue was $3.8. Market value is 3.8. But how do we calculate TERP? Guys, look at this. Calculating TERP is very easy. I had 4 shares for a value of 3.8 each. I got one more rights. I gave one more rights for 2.8 each. Correct? Take your calculator. I had 4 shares for 3.8 each. मेरे पास $15.2 worth of shares was there. Then I got a right, or I issued a right of 2.8. Now I have overall 5 shares for a cost of how much? For a value of 15.2 plus 2.8. It has an overall value of how much? Overall value of 18. Now 5 shares at a value of 18. 18 divided by 5. So my terp should be 3.6. What do? I will apply this terp. I will apply this bonus fraction to the one above the first transaction, 3.8 divided by 3.6. When I do this, now I can calculate the total weighted average number of shares. What do? 36 million multiplied with 3 by 12 multiplied with the bonus fraction of 3.8 divided by 3.6. That should give a value of 9.5 million here first. And here it is quite simple. There will be 45 million into 9 by 12. That gives a value of how much? That gives a value of 33750. So if I add both of them, my total weighted average number of shares will be of how much, guys? 43,250,000 shares. 43,250 plus 3 zeros shares. That should be my answer. Great. So I'll move to the next question. See, next question is theoretical question again. If you see, it's about the sustainability report. The directors of Harry Company have decided to prepare a sustainability report for the year ended 30th September X8. However, are unsure about the requirements of IFRS S1 standard. So they're asking which 4 of the following should be the core content of Harry Company's sustainability report. According to what? According to IFRS S1 general requirements for disclosures of sustainability related financial information. So if you guys would have studied in the very first chapter of ACCA Study Hub, governance, strategy, metrics and targets, and risk management. These are all the 4 things that we can include. So the answer has to be 1, 4, 5, 6. That means option 4. Yeah. So this is very factual. There's nothing that you have to read about it. The next, what are the common fundamental characteristics of useful information included in both IFRS? Both of the common is, everything is common. Yeah. In that, you see, relevance and faithful representation is the common one, because both are qualitative characteristics, the common qualitative characteristics. That is also factually there, and you can't change anything. Now, there is something called depreciation. Let's read about depreciation. At 30th September X7, Harry Company reviewed its depreciation methods and useful lives and elected to change the depreciation of machinery from 10% on a straight line basis to 11% on a reducing balance basis. So now what kind of an accounting treatment is this called as? How should the change in depreciation method? Guys, change in depreciation is treated as accounting estimate. Change in accounting estimate is always have a prospective effect, not a retrospective effect. So I can go ahead and consider the answer as straight option C. Change in accounting estimate with prospective effect. Now, great. Now we have the last set of 5 section B questions. I think section B goes little far because a lot of theoretical questions, since there are some case study based on it. Okay, so let's keep the next part. Which statement is correct regarding the accrued expenses? So it's about the accrued expenses. Please read only about the accrued expenses. All these are irrelevant, guys. Okay, so accrued expenses, what does it say? A statement of financial position includes an accrual for expenses with carrying amount of 2560. The expenses were deducted from profits in calculating the current tax charge for the year ended 30th June X6. Now how do we have to treat this? Here also I'm treating it as expenses, there also I'm treating it as expenses. That means this accrued expenses will also have an outstanding liability in financial reporting, also will also have an outstanding in taxation also. So the tax base and carrying amount both will be the same, hence there won't be any kind of temporary difference. The answer has to be straight option C, because the accrued expenses have a tax base of 2560, carrying amount should also have a value of 2560. There won't be any kind of temporary differences. The answer is straight option C. If you can read option A, B and D, option A says like the accrued expenses have a tax base of nil. No, both are recognize same concept. Here also it is treated as what? Expenses. There also expenses. So both are following accrual basis. So there is no chance it can become nil. The accrued expenses give rise to a deductible temporary differences and deferred tax liability. Guys, first of all, whether it gives rise or not, that is a different scenario. You need to understand deductible and deferred tax liability can never be the same. Deductible temporary differences will always have deferred tax asset. Taxable temporary differences will always have deferred tax liability. They have given both of them at one place, which is not at all right. That is, option B is not right. Then look at option D. The tax base of the accrued expenses is equal to the carrying amount, resulting in a deferred tax liability. If it is equal, then there won't be any kind of difference. No difference, no deferred tax liability. That's the reason option 4 is not the right one. The answer has to be option C. Sorry. These are all not right. Strike through. Let's move to the next. Oh, I have to see the gold screen. Next. What is the deferred tax charge to P&L in relation to the property, plant and equipment in the year ended 30th June X6? Most of them will get confused on this. Let's look at this. I'm going to explain that in the scratch pad. This question is for 30th June 20X6. Please understand. In the draft statement of financial possession, PPE has a carrying amount. The carrying amount of 196,500 and tax base is how much? 152,300. Now this leads to what? This leads to taxable temporary differences. How much is the taxable temporary differences? The difference between these two. How much is the difference? Take the calculator. It is 196,500 minus 152,300. So it should give a value of 44,200. So this will give a taxable temporary difference of 44,200. This multiplied with tax rate will become your closing balance of 30th June X6. This is what I know. Next, look at the next one. The taxable temporary differences related to the PPE at 1st July X5. Okay, the opening balances के लिए they have given the value. So on 1st July X5, they have given a value saying that the taxable temporary differences, the TTD, taxable temporary differences, are nothing but, they've clearly said it is 30,120 multiplied with tax rate will become your opening balance. Now after that, Hickson company management has decided to adopt revaluation model for property effect. This is where we go wrong. Revaluation is happening from 1st July 20X6, that is next accounting period, not the current accounting period. Irrespective, look at the question. The question is 30th June X6. I don't bother about the revaluation. All I have to care about is the current year taxable temporary differences. At the last, can you all see they have given the tax rate? The tax rate is 20%. Here I will multiply with this 20%. Here I will multiply with 20%. Let's find out what is my opening and closing balance. If there is an increase, it will increase your tax charge to the statement of P&L. So 144,200 200 multiply with 20 percentage. 8840 is my closing balance. Okay, what is my opening balance? 30120 into 20 percentage is my opening balance, that is 646024. Increase or decrease? Opening balance is 6024, closing balance is 8840. There is an increase of how much? 2816. So the tax charge will be how much, guys? 2816. You can type 2816. Next, we have a theoretical question. Which statement best reflects the accounting treatment that Hicks and Company must apply when it adopts the revaluation model, assuming the fair value of the property remains in excess of carrying amount? That's for the next year ending. So the initial revaluation surplus is recognized in other comprehensive income, gives rise to related deferred tax income. Guys, I think whenever there is a revaluation surplus is there, it increases taxable temporary differences, and that is recognized in not P&L account, it is rather recognized in OCI. The answer is clear cut option B, because revaluation surplus does increases your taxable temporary differences. Taxable temporary differences will increase your deferred tax liability, which increases, there will be a debit entry that should go to other comprehensive income. It's very simple. Next, it's about lease arrangement. At which of the following correctly describes the initial measurement of what? Initial measurement of lease liability at 30th June X6. Initial measurement of lease liability, if you guys all remember, it's about the present value of future cash flows. If you have any kind of variable lease payments that comes into the picture, plus if you have a purchase option exercise, plus any termination penalty. So here maybe you can give a read about it. On 30th June X6, Hicks and Company acquired the use of a machine by a way of a lease agreement arrangement. The lease term is 10 years. However, Hickson can terminate arrangement after 6 years on a payment of penalty. It expects to do so. That means I have to treat this also my liability. Termination penalty. The fixed lease payments will be made annually in arrears. Hickson Company also agreed to make additional variable lease payments each year related to the usage of machine. We have incurred 1250 installation and 750 legal fees. Guys, installation and legal fees should be added in right of use asset, not in the liability. So lease liability will be measured at the present value of the lease payments plus the termination penalty here. So if they would have added variable lease payments, I would have considered, but that has not been added here. The answer has to be option D. Simple. Installation cost, no. Installation cost, no. If you see fixed and variable lease payments only, no, you should have added termination penalty. Then comes the last question of your section B related to sales contract. Okay, sometimes if you see the question is longer, please understand the answer could be very easy. All you have to read is the requirement. What revenue should Hicks and Company have recognized in the year ended 30th June X6 in respect of the sales contract? Read the information. On 1st March X6, that is before the year ending, before almost like 3 months of the year ending, March, April, May, June, 4 months of the year ending, we sold 1000 identical items to the customer for a total of $12,000, offering 6 months credit. Very good. Doesn't matter. If I have obtained the control, if I have given the control, then performance obligation is satisfied, I can treat it as revenue. But Hicks and Company agreed to hold the asset for the customer until required for up to a year. It's a bill and hold arrangements. Bill and hold arrangements can be recognized as revenue irrespective the asset is being given or not, provided if the reason is valid. The reason of holding it is reasonable. Second, if you can keep that aside, if you're not utilizing for any other economic benefits and that is readily available for immediate delivery, then I can still consider that as my revenue. Read the point. Why we are keeping it? The customer has no storage facility. Tick mark. Hicks and Company holds the goods in a separate area of its storeroom. Very good. They are identified as belonging to the customer and available for immediate delivery. Guys, you don't have to worry about anything. Like we have not transferred. The entire $12,000 can be treated as revenue because it is treated as bill and hold arrangements. Right? That should be the end of your section B. And let's happily move to section C. I know it might be a little overwhelming. You guys can pause and take a break and come back and watch it because section C need a lot of energy. Yeah. So let's go. Let's read. Let's read the question, consolidation question. If you see, the requirement is to prepare the consolidated statement of financial position of Panama at 30th June 20x7. So now this question is clearly about a single requirement, that is statement of financial position. Everything which is being given, I will concentrate my calculations in only consolidated financial position. So if you see, Panama company operates in what? Panama company operates in manufacturing sector. On 1st March X7, it acquired 75% interest in a supplier Triple company. First of all, let's understand, is it full year acquisition or mid year acquisition? I'm going to write everything in my scratch pad for my understanding. So it is default indeed what? Indeed the mid year acquisition. Because if you see, on my 1st March X7 is my date of acquisition, but my year ending is 30th June 20x7, which is clearly said. In exchange for $200,000 cash and one of its own share for every 4 share acquired in Triple E company, the statement of financial position of the two companies at 30th June X7 were as follows. So we have two different types of purchase consideration. So the two different types of purchase consideration, one is cash, another one is treated as what? Another one is treated as share exchange. So let's go one by one. First we need to calculate the purchase consideration, or let's understand the working note number 1, group structure. So always prepare working note. The working notes may, the first one that you will prepare is group structure. So how do you prepare group structure, guys? We'll have to find out who's the parent company. So the parent company will be Panama company, because those are the people who have acquired us. Correct. So it is Panama company. And what is the date of acquisition? The date of acquisition is, you can just, I'm not going to write the full form, but in your examinations it is always suggested you write full form. The date of acquisition that we can expect to have is on 1st March 20x7. Then we need to now calculate the purchase consideration. So if you see purchase consideration, you can have a subnote within this. I will calculate purchase consideration somewhere here, right? So how does the purchase consideration works now? Okay. So my bad. Purchase consideration. So if you take purchase consideration, you can expect to have two types of purchase consideration coming into the picture. What are the two types that you can expect to have? One is cash consideration. So the cash consideration is quite simple. It is $200,000, and you have next share exchange. So share exchange, it is clearly says I'm giving one shares. See, I first of all I have acquired 75% of Triple company. Now Triple Co has how many number of shares? What is their total equity? That you will be able to find out in the share capital of Triple company, where you will get to know here. Okay, that is where you'll find out. So out of this $80,000, I have acquired how much? I have acquired 75% of it, and every 75%, every 4 that I have acquired, I have provided one share. So I will take 1 by 4, and finally I'll multiply with my market value of my company. If you can see, at the date of acquisition, the market value of Panama company share was $10 each. So this is something that you have to highlight, and this will be $10. We will use it for the calculation. So if I do so much, what is my purchase consideration that you can expect to have? I am acquiring 80,000 shares, may 75%. For every 4 share, I'm providing 1 by 4, and every share value is $10 each. You can expect to have the share exchanges $150,000. What is my total purchase consideration? The total purchase consideration would be sum of these two, that is $350,000. So let me go ahead and bold this, and here I will write it is $350,000. So I got the first information done. Next, what is the next thing that we have read out like one by one? What is the next thing? That we have the financial statements, and you can read Panama company has recorded its investment in AAA company at the amount of cash consideration, but has yet to make the entries for the share exchange. So that means if you see what we have to do, we have to go ahead and increase the share capital and share premium both of Panama company. Share capital and premium both of Panama company. How much I have to increase? See, share capital will be increased by the number of shares that I have issued. If you can see, what is my face value of the shares? Yeah, can you see somewhere what is the face value of the shares, people? The face value of the shares will be $1, right? The face value of the shares will be $1. And what will be the market value? It is $10 each. So now $1 will be going to where? One, because it's clearly said here both companies have a nominal value of $1. So we will go ahead and consider this as what? This as my share capital. So I have acquired, so how much shares first of all I have issued? Out of 80,000, I have acquired 75%. In that I have issued 1 by 4. Correct? So at $1 each. So my share capital will be of 80,000 into 1 by 4 into 75%. So my share capital will be increased by 15,000, but my share premium will be increased by 15,000 with the remaining value of premium value. So because I'm issuing 15,000 shares, but I'm giving at a market value of $10, where my face value is $1. The remaining $9 will be treated as what? $9 will be treated as share premium. It's my job to go ahead and increase that in my share capital and share premium. So this is something that you should know. So Panama company has recorded its investment in AAA company at the amount of the cash consideration and has made no entries for the share consideration. At the date of acquisition, the market value of the Panama company share was $10. So we have properly recorded this. Now the market value of AAA company is also given. Maybe it's for the NCI calculation that we have, which we can look into the next working notes. Now, so move forward. Panama company has elected to measure the NCI in interest AAA company as the proportion of net assets. For that, first I need to find out the net assets. Let me keep it on hold. Look at the third information given. At 1st March 20X7, AAA company's property had a fair value of $36,000 in excess of its carrying amount. The property has a remaining useful life of 20 years. So this goes to the calculation of what? This goes to the calculation of working note number 2, purchase fair value of net assets. However, we need to know, I'm going to leave few things which I don't know. So because I have to find out what is my retained earnings at acquisition for the calculation of fair value of net assets. Second thing, who's the subsidiary company? It is AAA Co. So this is my group structure. My parent company and my date of acquisition, and of course I will also have to write percentage of acquisition. So if you know this, most of the half of the things are easy for us. So this is my working note number 1, group structure. We have retained earnings to be considered, but let's wait for it. And you don't have to always do this, but I would always suggest you guys to have it properly aligned so that you yourself will understand instead of somebody else. Like you can give the references accordingly. Right, we are done with group structure. Let's move to the next part of fair value of net assets at acquisition. The second working note that we can do is, see, fair value of net assets at acquisition and post acquisition profit of which company? Of subsidiary company. I'll be able to get so much. Okay, so let's go. I will write the particulars or the element at acquisition, post acquisition, at reporting. Okay, start. Now, what and all includes in your fair value of net assets at acquisition? Few things are a default included, that is your share capital, share premium, and retained earnings at your reporting date. So, any increase or decrease is what we have to go ahead and consider. So, now if I have to take into the picture, I have, of course, share capital at the date of acquisition. Do not take the date of at the end. At the date of acquisition is 80,000. And do I have share premium? No. But can I calculate retained earnings? Yes. Now this is the time that I, just like how I calculated purchase consideration, I will also calculate one more thing, is retained earnings. As far as I know, I don't think so there is any kind of adjustments that I have to do for retained earnings. So what is my retained earnings at reporting date? My retained earnings at reporting date, it is given in the question, it is $371,000. $371,000. Now if you see, this is the draft financial statement for 30th June X7. I have gone ahead and acquired this company on 1st March X7. So that means how many months post acquisition profit I have to consider, how many months I have to eliminate. See, I have the reporting date, that is 30th June 20x7. Correct. So now if I have to find out what is my retained earnings at acquisition, the date of acquisition is on 1st March. I have to eliminate June month's profit, and I have to eliminate May month's profit, April month's profit, and March month's profit. So I have to eliminate how many months profit? Now I have to eliminate 4 months profit. So do I know if, because I wanted for what? I wanted for 1st March 20x7. For that, what do I have to do? I have to eliminate 4 months value. So how do we do it, guys? Of course, my profit for the year is already given in the question. Can you not find out how much is the profit for the year? So we can find out the profit for the year. In the year ended 30th June, we have made a profit of 33,000, which accrued evenly across the years. That means that's my profit for the year. So can I consider that? Yes, profit is 33,000. That into 4 by 12, I will go ahead and eliminate, so that I will get to know the retained earnings at the date of acquisition. So when I do this, I will get my retained earnings at acquisition will have a value of how much? $360,000 at acquisition. So what you can do, you can go give the reference to this particular cell. Yep. Okay. So now, do I know what is my retained earnings at acquisition? It is coming from working note number 1. Please give the reference as and when you write. You do not get to write just like the way that you want, because we will not be able to understand, the examiner will not be able to understand. Please give the reference as and when you give the reference, as and when you are taking the values from different working note number 1. Now look at this, read one by one. At 1st March X7, Tripoli Company's property had a fair value of $36,000 in excess of its carrying amount. I have a fair value adjustment. There is an increase in the asset value. So, increase in property, plant and equipment. It's my job to go ahead and add how much? $36,000. But however, we should also find out what is my post acquisition profit, because now I know my retained earnings at reporting is how much? My retained earnings at reporting is 371. So my post acquisition profit was 4 months profit, that was 11,000. That was clearly 11,000. Okay. Now in this, just because the value of the asset has been increased, we also should know if property, plant and equipment is getting increased, the depreciation on that will also get increased. So I have to go ahead and consider the depreciation, additional depreciation that you're supposed to charge on the value. So that much will, how much that will be? That will be based on this $36,000, and it also has told clearly it has a remaining useful life of 20 years. You take 20 years multiplied with 4 by 12, we will only charge the depreciation of how much? 4 by 12 months, because I am not supposed to charge the depreciation more than 4 months, because the post acquisition period itself is 4 months. So I take $36,000 divided by 20 into 4 by 12. So that becomes 600. I will have a changes in my post acquisition profit because of this fair value measurement. Then let's read the next part. What is the next part that is being given? Let's see if there is any kind of other adjustments. This was considerably low than in previous years. Fine. Panama company directors were aware that Triple E company was struggling to control the cost, and prior to the acquisition date, they had already decided to restructure Triple E company's business to eliminate a layer of management. This would incur expected redundancy cost of $60,000. The restructuring the restructuring plans were announced to Triple E company staff members on 20th March X7. The restructuring will commence in July 20X7 and be completed by December 20X7. The intended restructuring costs are not reflecting in either company's financial statements. See, the expected restructuring costs are not obligation of Triple E company at acquisition and are not included in its net assets, but as soon as they are announced, they become a present obligation. So you should be recognizing that as a provision, not right now. You'll be recognizing when? You'll be recognizing later. When will you be recognizing? Of course, when you prepare statement of financial position, I will add another point called as what? Another point called as provision there. Okay, great. So let's move to your next part. Throughout the year ended 30th June X7, Panama company has bought 8,000 goods. So that means, as far as I know, this should be the fair value of net assets. This should be the fair value of net assets at acquisition. So if I take the sum of all of this, this is my fair value of net assets at acquisition. And what is my post acquisition? Let's see if there is any other additionals. So I will keep this for now because it is used in the next working note number 3, goodwill at calculation, goodwill at acquisition. I'll leave some space. If I have any kind of provision for unrealized profit, I'll have to make changes. So working note number 3 will be goodwill at acquisition. So what and all I need if I have to calculate goodwill? I need purchase consideration, and that purchase consideration is coming from where? Purchase consideration is coming from working note number 2, which we have already calculated and kept. So how much that will be if I move forward? It's going to be $350,000. Then I have to less fair value of net assets at acquisition. That is coming from working note number 2. We just calculated, and that is minus symbol 476. Now I have to add NCI at acquisition. It is purely on proportionate method. Whatever you have the net assets, on that I will take the 25% of 25% of what? 25% of my fair value of net assets. That becomes my non-controlling interest. When I do, what am I getting? Let's see whether I'm getting a positive figure or negative figure. If at all, if I'm going to get the positive figure, it's goodwill at acquisition. If it is negative, we call it as what? We call it as bargain purchase. Now what is this bargain purchase? It's a credit entry to parent companies. That is, who's the parent company? Panama companies statement of P&L account. Hence I will have to go ahead and make a changes in when? I will have to go ahead and make a changes in retained earnings of 7,000. So I will add to group retained earnings, that is working note number 5. That is goodwill at acquisition. So this working note is pretty much simple because we have the ready information coming from different thing. So but however, I will go ahead and consider this as a different working note. Keep aside. Okay. Now move forward. Read it. Throughout the year ended 30th June X7, Panama company has bought 8,000 goods from Triple E company per month. Triply makes a markup of 25% on these sales. At 30th June X7, Panama company still held all of the goods bought in May and June X7. It still owed Triply company for all the goods bought in June. So it's little tricky, but you just have to understand one by one. Let's prepare working note number 4. I will always keep working note number 4 as non-controlling interest. I'm keeping aside, let's keep at least like some 4-5 lines, and let me go to working note number. You can always interchange, guys. I will always keep working note number 4 as non-controlling interest, 5 as group retained earnings. I can keep working note number 6 as perp, that is provision for unrealized profits. Now we should know who's selling to whom. Okay, so clearly it says throughout the year ended 30th June X7, Panama company has bought $8,000 goods from Tripoli company per month. That means I have gone ahead and made an intra-group sale March, April, May, June. Correct. But however, only Tripoli company, like whatever it has been bought, Tripoli company made some markup of 25% on these sales. At 30th June X7, only it is having an asset worth of March and May and June ka 2 months are the one which is lying in the inventory. 2 months are kept in the inventory. So for this, what do you think I will have to go ahead and do? I will go ahead and consider $8,000 into 2 months are the one which is lying in the inventory. That is of how much? That is of $16,000. Now it is at markup. If there is a markup, then my sales will become 130%. My sales will become 125%. I'm sorry, my bad. It's because markup of 25%. Hence you can expect to have 125%. Now this $16,000 is at what? It is at percentage of 125%. What is my cost? Because ultimately I have to find out what is my profit element. So my profit element would be how much, guys? My profit element is 25%. So all I have to do is cross multiplication. How do I do cross multiplication? If 125% is $16,000, how much do you think 25% would be? 25% into 16 divided by 125. That should give me a profit element of how much? 3.2 million of value. Now this 3.2 million will be treated as what? Oh sorry, 3.2 million, of course. Yeah, so this 3.2 million will be considered as what, guys? It will be, see, every calculations happening here is in thousands, and I believe these things like you can consider as 36,000. Correct. So 3,200 could be called as 3.2 thousand. That's should be the ultimate figure. So this is my perp. Now who is the seller? Subsidiary company is the seller. Who's the buyer? Parent company is the buyer. So what do I have to do? I have to go ahead and consider, I will give half of the share to whom? I will give 75% of the share to this person, 25% of the share to the non-controlling interest. For this, you don't have to do that. Instead, that's the reason I've always keep a simple working note called working note number 2, post acquisition profit. You can always come and make the adjustment of working note number 6 perp here, and you can reduce, because ultimately it is going to reduce your subsidiary company's profit because he or she is the seller. So what you can do, you can go ahead and generally what will you do? You'll debit cost of sales no matter what, whoever is selling, 3.2 million. So we will credit group inventory. In the group inventory, I will have to go reduce 3,200 no matter what. But however, whose profit it is going to get affected? It will get affected to the subsidiary company, that is Tripoli company. So that's the reason I have gone ahead and made changes in the post acquisition profit, because this is purely about post acquisition profit, right? Yeah. Now read the upcoming information that I have. We have certain more information given here itself, which is helpful for us to understand the further. There is something called intra-group balances which we need to know. So they are clearly saying that in the current liability, 1 month income, 1 month sale is still included. It's still OEEE company for all the goods bought in June. That means I think it should be having a $8,000. So we have to eliminate that from current assets also, current liabilities also, because your receivable is my liability and my liability will be your receivables. You have to eliminate in both of the places. Apart from that, do we have anything else? We have the last information. Panama company acquired its investment property at 1st Jan X7. The property cost 144,000, had a useful life of 50 years when it was acquired. Okay. Panama company directors decided to adopt fair value model for investment property and have been advised that the fair value of the property is $170,000 at 30 June X7. Owner recognized the property at cost. No accounting entries have been made. Guys, any increase in it, we just have to add it in where? We have to add it in retained earnings and increase your investment property at 170,000 by recognizing 26,000 of profit that goes to your retained earnings. So apart from this, I don't think so I have anything else what I can do. I can start calculating other things. What are the things that I have to calculate? So now I'm done with purchase consideration, I'm done with retained earnings, so this is done apart. You can keep working note number 1 is good. Working note number 2, may you have to find out what is the post acquisition profit of Triple company. That is nothing but the sum of, I made the profit of 11,000, but in that I had certain adjustments. 7,200 is my post acquisition profit. In this we will give Panama company के लिए share of 75%. that will be 7,200 into 0.75, and for non-controlling interest I will give a share of 25%. Instead of you giving separately, you can directly go ahead and make adjustment to your post acquisition profit and then give the share accordingly. That is far better. So I am good to go with working note number 2, fair value of net assets at acquisition 2. Then comes working note number 6. We are good with that. We have working note number 4 and working note number 4 and 5. So you can prepare working note number 4 somewhere here. Non-controlling interest. So what was your non-controlling interest before? Non-controlling interest. What NCI at acquisition that we calculated based on proportionate method, if I'm not wrong, guys. How much was that? It is calculated and kept here. Just go take the reference. Next, you have to add post acquisition profit share coming from working note number 2. How much is that? We have calculated and kept. It is 1,800. So apart from that, is there anything else? Non-controlling interest is there? I don't think so. I'll have to find out what? I'll have to find out what is my non-controlling interest at reporting. NCI at reporting will be the sum of these two, which will be 128,800. Oh, sorry. Yeah. Correct. So 120,800. Now, is there any other things that I have to go ahead and consider? Of course, yes, guys, there is a restructuring provision which I have to take place. So we discussed about the $60,000. It is purely a post acquisition thing, if you can all see here, right? So we have to consider this redundancy cost as my provision. Whose provision? The subsidiary company's provision. Hence I would have debited as an expenses. Go make changes in your post acquisition profit. So what you have to do? Less provision created. For how much? Provision created of 60 for restructuring. Maybe you can write it as restructuring. If you do that, what is the value that we would go ahead and do? It is of $60,000. So when I go ahead and consider what is my post acquisition profit, you can expect to have a post acquisition profit of, I think we have a loss, post acquisition loss of, okay, so I have to consider how much? I have to consider 1. See, automatically it gets changed. That's the reason I always tell you guys, give the reference. Now I have not made any changes. Automatically it has changed. Okay. So always give the reference so that it is quite easy for us. So there's a post acquisition loss of 50 to 800. In that I give 75% to Panama company, 25% to non controlling interest. So non controlling interest at reporting will be how much? It will be 105 800. Then comes the last working note for us, which is working note number 5, group retained earnings. So we'll start with Panama companies RE as per Panama companies RE as per what? As per the books. What is the retained earnings according to the books? If you can see, it is $518,000. $518,000. Then add, or here it is actually less, post acquisition loss of whom? Loss of AAA. How much that is? All you have to do is go give the reference whatever we have calculated. I don't think so you have to do anything else. How much is that? That is of 39,600. I have gone ahead and done that. Apart from this, is there anything else that I have? Yes, I have. The next thing we consider that as what? Next thing that we have is so many things that we have to consider. So there is something called fair value increase, guys, that we had. Add whatever it affects your parent company's profit should come to group retained earnings. So what do we have? We have increase in fair value measurement. That is of how much? That is of, see, you don't have to use your calculators, you can do it directly here. See, I purchased the asset for $144,000. Now it has been measured at 170. So it should have a fair value gain of 26,000. Simple. And coming from bargain purchase, we have working note number 7. Working note number 3, we have 7,000 as profit because I purchased my subsidiary for a lesser cost than it is worth for. So it is treated as what? It is treated as my income, bargain purchase of goodwill. Then what else we have? The next, apart from these things, we have acquired for post acquisition loss, and we have acquired for fair value increase, we have acquired for bargain purchase. I think that's all. What should be my group retained earnings that goes to statement of financial position? My group retained earnings will be 511,400. That should be the value. This is my GRE going to statement of financial position. I have everything ready. Can I go prepare statement of financial position of these two companies? Yes, you can go ahead and start preparing the statement of P&L account. Statement of financial position, sorry. So what do? I'll have to take the consolidator. You have to give the heading. How do we give the heading? You can give something like this. Okay, so I've just copied it here, guys. Yeah, you can do the same thing. So consolidated, see here, you can copy and you can paste it. You don't have to sit and waste your time on that. So we will start with non-current assets. Under non-current assets, is there any calculations that we have? See, I know it's property, plant and equipment. In that, please write the full form. Yeah, property, plant and equipment. Parent company is $480,000 plus subsidiary company is $457,000 plus, look at this. What is the additional thing that I have to do? See, I have gone ahead and added 36,000 extra, but in that I have depreciated for 600. The remaining 35,400 should be added to where? Should be added to your statement of financial position. That's coming from working note number 2. Please give a reference. When you do this, what is the non-current asset that you can expect to have? $480,000 plus $457,000 plus 35,400. So in total 972,400. That is what your property, plant and equipment is. Then comes investment property. So in investment property, guys, it's Sida Sada $170,000 because you already have a fair value. You can directly write it. So if you want, you can give the calculations here. So you had initially you have recorded at 144,000 and you have a profit of 26,000 fair value gain, and you can write that and this will go to the sheet. Done. What is the next thing that we have? Do we have goodwill? First of all, we don't have goodwill. Please, investment in AAA company we are not supposed to show. because you can't have investment within your own organization. That's about your non-current asset. Then we go with what? Then we will go to current assets. Current assets may I will start with what? I will start with inventory. So do we have any adjustment in inventory? Yes, provision for unrealized profits. Inventory of parent company 63,000, subsidiary companies 42,000 minus working note number 6 per of how much, guys? It was 3,200. See, I'm crediting group inventory here 3,200, and do the same calculation here. It will be 63,000 plus 42,000 minus 3,200. That should give me 10,1800. Then comes what? Then comes receivables. Do we have any adjustments? Yes, there's one adjustment called intra-group balances, a small adjustment. 41,000 of parent company plus subsidiary company के लिए 24,000 minus, there's no working note, but you can just reduce 8,000 saying intra-group balance. Yeah, so if I do that, how much is my receivables? My receivables will be 41,000 plus 24,000 minus 8,000. That should give me a value of 57,000. Then if I go to cash, I think only parent company has the cash. You can directly go write 10,000. More than this, I don't think so any other assets are there. What are my total assets that you can expect to have? My total assets will be of sum of all of this. My total assets should be this much. Now, what do I do? Generally, sometimes until I can't wait until unless. So what do? I go prepare the sum of whatever I'm gonna include in my equity part. I don't know how much I'm gonna include, but yes, I will start considering that. It is 0 now, but it's fine. So next, what do we have to consider? We have to consider the equity part. Under equity, I will start with what? I will start with share capital. Do I go ahead and record share capital of parent and subsidiary? No, but parent company 100 plus working note number 1. Remember, we have calculated purchase consideration of 15, so that we will go ahead and add. That is $100,000 plus 15,000. Overall, it is 115. Similarly, we also have share premium. How much is the share premium? We have the existing share premium of 35 plus 135 coming from again working note number 1. So that will give me how much? That will give me 35,000 plus $135,000, 170,000. Then we already know we have calculated group retained earnings from working note number 5. So that will be how much? Go give the reference to the cell because you have already calculated. That's there. See, why do I do it? You see, automatically it takes the sum of everything that I'm doing. Yeah, I don't know if you can see. Yes. So you can see the sum of it. So that's the reason it is always to keep that. And I know what is the difference that I have to still get it. Okay. Then non-controlling interest is there. We have to go ahead and find the non-controlling interest in a place. That will be, you can leave one space and write, but it's fine. Non-controlling interest at reporting coming from working note number 4. So we have calculated and kept, so it's going to be easy for us. NCI at reporting is 105,800. Let's move forward. Then what do we have? I think so far is my equity. Next we have to go for non-current liabilities. So what are the things that you can expect to have in non-current liabilities, guys? Whatever is given, I don't think so a big deal is there in non-current liabilities, because non-current liabilities may the parent company has $180,000 and subsidiary company has $40,000. You can directly write, I don't think so any adjustments are there, you can directly write $220,000. Now look at the current liabilities. There are certain adjustments that you should know. First thing, we have $105,000 of parent, $32,000 of subsidiary, minus 8,000 of intra-group balance, because if you're eliminating from receivables, you should also eliminate from where? Payables. Plus, there is $60,000 of provision that you have to create. Correct? Yeah. So if I do all of this, $105,000 plus $32,000 minus 8,000 should give me 1251. Minus 8 plus 60, I'm sorry, plus $60,000 should give me 1311200. Is it matching with total assets? Yes, it is matching with total assets. My total equity and liabilities will be nothing but this. Guys, you can have your own you can have your own arrangements on this. I mean, you can go ahead and you can do decorations and everything, whatever you want. But however, that should be the answer for what? Answer for your statement of financial position consolidation for 20 good marks. See, as far as I know, if you've seen, I've done this question in 40 minutes because I have read this question. So maybe you might take 5 minutes to read the question prior. So 45 minutes may this question should get over, maximum 50 to 55 minutes, not more than that. Beyond that, you're taking too much time. This is about the first question in section C. Now let's move to the next question of section C. So you guys can do the decoration for this accordingly. Yeah, I've just done the part of explaining the working notes and everything. Of course, even if you do this way, the ACCA will still give you marks. You don't have to worry about it. Okay, now comes the interpretation question. Wow, I did expect this. See, when it comes to interpretation question, we should know it is always subjective in nature. So I might do the calculation to the ratios, but when it comes to the 16 marks explanation, if you see the requirement, calculate equivalent ratios to those listed for Corey Company for the year ended 31st December 20x6. I might do this, but when it comes to analyze and comment of the financial performance and position of a company, I can give you guys a model answer, but provided you guys can write an answer and always mail it to me. There'll be an evaluation done based on the students. Yeah, there'll be an evaluation team who'll actually go through your evaluation and give you the feedback. But I can give you the model answer for that question where you can go through that on your own. Yeah, but however, I can give a plain explanation on that. So read the part. Corey Company is a cloth manufacturing company with a majority of its revenue generated through sales of fashion retailers. It summarized financial statements and ratios for the year ended 31st December X6 and X5 comparative for statement of profit or loss OCI are as follows. We have revenue and let me keep it big. Yeah, we have revenue, we have cost of sales, gross profit, and all of that. So they're asking us to calculate equivalent ratios. Now, ma'am, how do we know we have to calculate these ratios only? Like, sometimes we might not know only like which questions, what ratios that we have to calculate and everything. See, they've asked the question for 4 marks. Okay, you please see if there is any kind of ratios which is already calculated. If you can see, we have so many ratios. Gross profit 1, 2, 3, 4, 5, 6, 7, 8. These are all the ratios that we have. So you have to go ahead and calculate the same ratios once again. Now, how do we do? Let's read the part. We have all the informations here. We have all the financial information. Let's read the notes. The following information has been provided by company directors who publicly announced that Corey Company performance has been affected by the overall economic recession. However, the company has shown resilience despite the cost mentioned below. Okay. Corey's factory building has suffered impairment revaluation loss of 11.5 million in the year ended 31st December X6. The excess of these losses over previous revaluation surplus has resulted in a charge to cost of sales of 2.5 million. Okay, there were no additions or to disposals to property, plant and equipment during the year. So maybe while you're preparing gross profit margin, you can eliminate and show this because of impairment this has happened. Otherwise, the operations still was fine until unless the loss, because if you see, impairment can cause a lot. It is not an actual loss, it is a loss that we incur it. I mean, like, you'll not be able to recover the value of the asset and we treat it as loss. So because of this, your gross profit margin might get a hit, net profit margin might get a hit. Then, as a part of a cost cutting strategy, the company made some senior and skilled employees redundant during X6, incurring redundancy cost of 1.8 million. Again, I would have gone ahead and considered this as my provision expenses, where my expenses increases and my liability also increases, which reduces my overall net assets. So, Corey company also reduced its expenditure on marketing and advertising, which is also included in operating expenses. It might balance, but not so much because it's 1.8 million. The bank balance of Corey company has improved by 2.2 million and the bank borrowings have decreased by 1.5 million as compared to the balances at the previous reporting date of X5. Maybe that's because of I might have made some repayments. One thing, and company made a fully, there is a rights issue that we have gone ahead and made. So first what we have to do, we have to calculate a certain percentages, gross profit margin. So let's calculate gross profit margin. How? Let me include a table, guys. I need gross profit margin, the ratios, I need the workings, and then I need the ratios. Okay, so I need gross profit margin. What is the working? How do we calculate? It is of revenue divided by the gross profit divided by cost of sales. X5 they've already calculated. It's your job to calculate for X6. So 8 million, you can take this as ratios. This is ratios and these are all the workings. You can also include you can also include 20x5. We will calculate 20x5 is there. We might have to calculate 20x6. This is the information that I have to go ahead and do. Oh, sorry. Yeah, 20x5 will be there. So we will start with gross profit margin. What is the gross profit margin that we have? We have to calculate gross profit, that is 8 million upon 59 million. So 8 million divided by 59 million should give you a ratio of how much? Yes, you can use this calculator or you can use your own calculator, whichever it is. That should help you. Okay, I'll keep scrolling up. Don't worry if my head is there, it's fine. So 8 divided by 59 should give me approximately 13.6 percentage. I believe that's what even you guys will get. So 13.6 percentage is my value. And 20x5, for a comparative information, you can find that out. 20x5, it is 26.4 percentage. There's a huge hit. So why this could have happened? Of course, like we have a increase in cost of sales because of an impairment, but you don't write that way. There is a way to write operating profit or loss margin, whatever that we have. So the working will go this way. What is my operating profit or loss? Do I have operating profit? Oh, I have loss, that is 0.7 million. I have 0.7 million divided by again 59 should give me a value of how much? I should have a value of 1.18. So let me keep 1.2 percentage, and that's a loss. So whenever you have loss, you can consider this way: 0.7 million divided by 59 million. Please put multiplication symbol into 100. That becomes 1.2 percentage. But to have the comparative figures, I'll be able to find out that is 14.7 percentage is my profit last year. Correct. Last year it was profit. This year it is a loss. Keep it in the bracket. Okay. Then what do I have, guys? Then next thing that I have is return on equity. How do we calculate return on equity? What is the formula for return on equity? The return on equity will be calculated based on the equity value. Let's see what is the equity value that we have. 35.2. It's my total equity. and I will be taking the 3.1 million profit. This profit I will have to take profit for the year after tax. So I will take 3.1 million divided by 35 point, how much? 35 point, where is the hell is it? 35.2 million. So that should give me into 100 again. It's okay if you don't put 100, guys, as long as you're able to understand what is the answer. So 3.1 divided by 35.2. If I do this, I am getting somewhere around 8.8 percentage. So you can keep that as 8.8 percentage. So 8.8 percentage is the another value. So if I go back for the comparative information, it is 15.6 percentage, and the next is 15.7 percentage. The next is net asset turnover ratio. Asset turnover ratio. How do we calculate net asset turnover ratio? Once again, we will have to take the revenue upon PPE. Revenue over property, plant and equipment you can take, or revenue over net assets you can take. Okay, so what is the revenue that we have generated? It is of 59 million divided by your equity value is 35.2 million. So that gives how many times? 59 divided by 35.2. So that becomes 1.67 times. Yeah. But here it is 1.5 times. Correct? Okay. Next that we have is gearing. The formula is given there. Gearing debt upon equity is what you have to calculate. Now most of the times I get people asking, ma'am, if debt is given, what is debt, what is equity? We always get confused. See, in this question, if you take, the debt is gonna be the interest bearing debt. Okay, equity to same ही है, like 35.2 million is the equity that we have. But let's see the debt, how much we have. See, this bank borrowings alone is the debt. If lease liability would have been there, I can add. Deferred tax is not a debt. Okay, so trade payables also not an interest bearing debt. So I will take only 8 million divided by 35.2 million. So what is my debt over equity? 8 divided by 35.2. So that's around 22.7 percentage. And finally here 21.5 percentage. Not a big change. Okay. And then we have trade payables, trade payables period. Then we have receivable collection period. I'm just writing so that we know what we have to calculate. Receivable collection period, and then we have finally inventory holding period. These are all the things that we have to go ahead and calculate. Let me write their metrics. It is 23, 19 and 18 days. 23 days, 19 days and 18 days. Let's calculate ours. Trade payable period. So trade payable के लिए I need few details also here, because trade payables I will have to take the value of payables, and I should also know what is my cost of sales. So what is my cost of sales? If you guys can see, my cost of sales is 51 million. And what is my trade payables? My trade payables is 66.8 million. So I take 6.8 divided by 51 multiplied with 365 days. It's 48.6. When you have 48.6, please consider that as 49 days. I take 6.8 million divided by 51 million of cost of sales multiplied with 365 days. That gave me an answer of 49 days. I'm taking a longer time to pay my suppliers, which is not a good indication. Then comes, I have to calculate what? I have to calculate the receivable collection period. I'll take the revenue for this because there is no credit sales revenue for this, and I'll have to take the receivables value. So what is the receivables value that we all can see? The receivables value that we can see is 4.4 million, and we know the revenue is 559 million. 4.4 divided by 59 into 365 days, it's 27 days. You can consider that as what? You can consider that as 27 days. See, if again point wise I sometimes tell you can take directly, I mean 27.2 days matlab it's going to be 28 days, but still for the numerical stuff you can always consider the rounding off method. 365 days, that should give 27 odd days. Next, the last thing that you can expect to have is what? The last thing that you can expect to have is inventory holding period. How do we calculate inventory holding? Let me keep this. Yeah. So how do we calculate inventory holding period, guys? Inventory holding period are calculated through, we need two things. What are the things that we require? One is our inventory, second one is cost of sales into 365 days. I already know my inventory is 4.4 million. If you can see here, my inventory is 4.4 million. I'll take inventory of 4.4 divided by my cost of sales is 51 million already. That divide into multiplied with 365 days. If I do that, I should get a value of 4.4 divided by 51 into 365 days. Guys, you do this, you'll get, trust me, you will only get what? This will become 31.41. I can keep either 31 days or 32 days, doesn't matter, guys. You can write whichever you want. So you do this, you'll get only 4 marks. Trust me, it looks like very easy. Ma'am has done all the ratio calculations, so it looks like very easy, but it will not fetch you any kind of marks. Trust me, only 4 marks you'll get. Analyze and comment, here is where you have to go ahead and consider. So what are the values that I will go ahead and consider? I will add the mock answer in my description of the video, but however, see, looks like, I'll just give you overview. I'm not going to type it, just give you overview. So if you look at P&L, reflects economic recession because revenue is almost reduced. Take consideration, my revenue was 72 million, abhi to it is kali 59 million is there. The revenue has reduced almost by 20%, and the gross profit has reduced almost like 19 say 8 tak, like it is almost more than 50% which has been reduced, right? Close to 55%. And if you look at my operating profit, now it is converted into operating loss. So, and positive after tax profit is reversed to a loss of 3.1 million now. So why do you think this is happening? This is purely happening because of multiple reasons. If you see, 15.4% of equity now is reversed to negative 8.8%, because here I think this was minus, this we didn't consider. Yeah, so here it becomes minus negative figure, which has turned completely less. So the decrease in cost of sales, if you can see, the cost of sales has been reduced. The cost of sales has been reduced not by a great figure. For 72 million I have a cost of sales of 53 million, but for 59 million also I have 51 million. It is hardly reduced by 2 million. So, and you can see there might be a fixed overheads, like production overheads mostly high is there, or you're sourcing the high raw materials, like it is, even though there is a marketing expenses you're reducing, maybe you're not enough marketing for the assets, for the revenue to be generated. So we can expect to have, there's a future potential revenue decrease also because of very close, if you do the closer analyzation, it shows the performance of the company. It may be better than what it is initially indicated, but There is a huge downturn that has resulted in different additional cost in XX, including that employee redundancy cost, like impairment that has happened, losses on financial asset investments, and if you can see, there are most likely non-recurring costs that is included in the financial statements. So if you anticipate this recession and its future effects, of course, like the company may not opt to sell its may it's fine. It's, I think, end of the day they might have to sell their financial assets into the future to balance their losses or mitigate their losses. So if the non-recurring costs are removed, that might be better, right? Because if you see, there is a huge dip in the revenue and gross profit margin because of the impairment loss. Now, if you look at the position, looks like the non-current assets had 11 million, and as you said, there's an impairment loss which is hugely hit of 11.5 million. There is a decrease in the non-current asset, so of course that could be a problem. But however, the one good thing in the organization is we have raised money through rights issue. Because of this, where we might have gone ahead and make a payment. See, the company made a fully rights subscribed rights issue during the year to help improve cash flows. So the director reduced the dividend per share by 45% as compared to previous year. That means we have reduced other cash flows. That is the reason my bank balance has been improved because of this reason, maybe. So and at the however, if you look at the movement in retained earnings, look at the retained earnings movements. It has 12 million for 31st December X5 value, and you look at here, it is 7.2 million. Maybe the payment of dividend may seen as like future recovery, because there's, even though so many things have been changed, my retained earnings have not had a major changes. But however, the other positions like your trade receivables, payables, payments period, everything shows that there is a decline for the organization. Look at this, I was paying in 23 days, now it is almost increased to 49 days. Now I was able to keep my inventory in, I was able to rotate my inventory in 18 days of time, but now I have to almost wait for 31 days. Correct. I was able to make a payment of to my receivables in 19 days, now I have to pay in 27 days. All of this, even though your borrowings are decreased, you can see the gearing ratio is hardly, slightly, it is still increased in nature. You make a high rights issue, it should have actually reduced your gearing, but still it is not. So how do you write the answer? Like, of course, as I said, you guys have to just find the downloading option in the comment, like in the description of the video. But however, understand, there is a strategy to write your answer, especially when there is a interpretation question. First, discuss what is the numerical change. First point, whether it is increased or decreased. What could be the potential reason? Potential reason. Always talk about may, would, could. Do not say yes, this is the reason. Second, what is your opinion on that? Okay, what could have been the adjustments? What do you think the possibilities are? Fourth, give a small conclusion about it. What could be, what can happen because of this? Let's say if you tell the revenue is dropping down, of course I would say that the assets are not being used, performed properly, or maybe since the assets have been impaired, now it has not a good performance, it's better to sell off those assets. We have raised cash, it's better to invest in there. So we will start having our own thoughts. How does this work out, guys? Of course, if you at least write every single day one question 15 days before your examination, that's an easy going. Right now, with just 10 days of examination, if you're watching this, I don't think so it's a good idea. It's better to go through the model answer and have your own version of it, and you can utilize that in your examination. So that is your whole mock that of all the 32 questions from section A, B and C. So if your exam looks like this complete, trust me guys, I'll be the most happiest person. However, you do have an option to review the flag. Agar kuch flag kiya, like that you don't know the topic or you don't know the question, you always have an option to flag it and come back and have a review it. But however, if it is not done, please finish the examination in time. Time management is very, very important. And especially when it comes to section C, do not waste your time hours together. I've seen students wasting like 2 hours, 2.5 hours in just section C. Even though they know answers in section A and B, they don't write the answers. Start always with section C, because it has a lot of impact. But however, ma'am, I'm comfortable with section A B being started because I'm very good at it. Go for it, it is totally up to you. I generally start from section C and then move to section A or B. So just because it's a mock, I had to start from section A today, but it is totally up and hold you. So you can do whatever you want, it's your examination, but provided do have a time management. And I know the exam ke liye hardly 10 days are there, guys. Please go revise the topics. It's always better to know your known devil than going to the new angel. It's fine, do not go to the new topic if you don't know. Start revising the existing topics as much as possible, I mean, like, as much as questions you can solve. That should be the best advice that I can give. So all the best for all those students who will be writing the examinations in the upcoming week. So if you guys have any questions, doubts, you can always comment through. I will read each and every single comment. Yeah, so thank you so much for staying so long. So all the best, have a great day. Thank you.